2, 1. All right, welcome back, everyone, to the Mr. Rent-to-Own Homes show. My name is Dominic Danino, aka Mr. Rent-to-Own Homes, and in this episode, we're going to be talking about top 5 reasons why Rent-to-Own Homes US is the best rent-to-own homes program in the market. And today I am joined again by my friend, real estate agent, investor in Colorado, Mr. James Brown. Welcome, James.
Thank you.
How you doing, buddy? Good.
Good. Let's get into this.
Cool. Yeah. So let's dive deep into this, right? So what makes us the leaders, or what makes us the best rent-to-own provider out there in this market, right? So we kind of jotted down some of our top 5 reasons for that, right? Mm-hmm. So number 1, our goal is truly to help people become homeowners, right? So when we say that is, we're not looking to keep houses. We're not looking to build an inventory like some other companies out there. No, there are some smaller players and even some of the big ones that really don't analyze the person to make sure that they can complete the process to be able to keep the house, right? They're just taking a small deposit. They're basically landlords in the sense, right? They're just hoping, hey, you don't complete the process, that's okay. I continue collecting rent, right? And then whether you complete the process, get the house, that's a you problem, not my problem, right? And if you don't and you leave, they would just go do it again. That's that's the way that they look at it, right?
Yeah, they're getting people that have an owner's mindset, intending to buy a house, and maybe setting them up to fail, right? Either intentionally, which I don't know how they sleep at night, or unintentionally, right? Especially smaller operators don't know like how to really set things up for success. And that's unfortunate, but it happens all the time. I talk to people all the time that happens. It's like, oh, well,
they sort of been burned, right? I mean, and I got to say, I mean, there's a sense of responsibility that comes from the person that's getting into that too, right? Mm-hmm. So I'm not going to say that everybody's bad or does it intentionally, right? As long as everybody knows up front what's happening, who's responsible for what, and everybody goes in with eyes wide open. And sometimes people, kind of get amnesia of these conversations and so forth. So obviously documenting is important, making it very clear on your agreements that, hey, this is what you're responsible for. This is what I'm responsible for, right? And this is our timeline, and this is what happens if you don't do your part, right? We like to tell people, it's like, we'll do our part if you do your part, right? So if you do your part, there shouldn't be any problems, right? But somewhat, like you mentioned, some of the smaller players kind of learn a rent-to-own method, sort of, seller finance or something to that effect, where unfortunately part of the strategy for them is hoping that the person does not complete the process, right? And so that definitely leads to point number 2, which is part of that, and why we feel ours is the best, is because we screen the rent-to-own client thoroughly to make sure they're a good fit and are set up for success, right? And when we say that screening them is, hey, can this person really afford it, the payment? Can they really afford this house? We don't put somebody in $1 million house if their income is $25,000 a year, right? They can't afford it. They won't be able to complete the process. They'll never be able to qualify for traditional financing at the end of their term, right? So we want to make sure that we understand their situation and that what's keeping them from qualifying today gets resolved by the time that their agreement comes to an end, and they're working on it, and we may check on them, or we'll work with a lender or even a credit repair company to make sure that they're on the path to getting it resolved. Now, obviously we can't hold a gun to somebody's head, or we're not babysitters per se, right? But they have to come in with the understanding that, hey, they got to do their part, follow through. And if you don't, just like anything else, right? Just like at your job, just like if you get a loan from the bank, if you don't do what you're supposed to, you don't make the payments, or you don't do this, that, or the other that you're supposed to, there's going to be problems.
Yep.
Right? So we would like to work with adults, people that are, right? I mean, really, I'd rather, I say it all the time, right? It's like, we want to work with adults, people that are responsible and want to have a sense of ownership in the process, and we give them that. Right? Do they generally want to own the house? If they're ho-humming, or if they're not quite sure, it's like, well, I'm just going to test it out and see what it says, and I don't intend on owning it, then this isn't the program, right? That's why we call it rent to own, not rent to rent.
Yeah.
Right? So, I'm very clear with people about that. Look, it's like, we're not going to twist your arms, and I kind of use this term, like, we want volunteers. We don't want any hostages. Right? Not gonna make you. It's not a hard sell. Like, oh, we're gonna twist your arm. You gotta do our program, right? It's like, no, we get plenty of business. We get the right people that actually want to buy home, because home ownership gives them stability, right? This is not a speculation kind of program. If you're expecting to move into the house and the house is gonna go up 500,000, and then you're gonna flip it the next year and this, that, and the other, this ain't it, right? This is for people that have a long-term view on housing, that want stability. Most of them are going to be family members, or families, right, with kids, and they like the school district, they like the area, they like the neighborhood, right? It's close enough to their work, whatever that may be, that drawing them to that particular area. So they have an outlook of at least 5 to 10 years to be in that neighborhood or in that house, right? Now, they're usually not in our program for that long. But what I mean by that is, hey, if they're speculating and I'm saying market up and down, no, this is for home ownership, right? Yeah. If you're tired of bouncing from this apartment to this house, and my landlord's selling their house, and I got to find another place, and the landlord just jacked up my payments, or now they're adding this to this or that or whatever, right? If you want stability, this is the way to start. If you're not able to right now, right? So home ownership, to me, it's about stability. And also the opportunity to participate on the upside of the appreciation.
Yep.
Right. We've had many people in the last couple of years come in, and then they built equity through the program, right? And also the beauty of our program is, unlike some others, they know what their payment is going to be for the period that they're with us, right? We don't increase it after every 12 months like some other programs out there. Right? They also know the price that they're buying the house for. So they know exactly what they're getting into. So that way they can work on getting their either their credit or their income situation, or filing their taxes on time, or whatever that's keeping them from qualifying for financing right now, get it cleaned up so that they can, right? So us screening them and understanding, me as a lender, understanding, okay, what are the pitfalls in your particular situation that could come up when you go to a traditional lender to get an FHA loan or a conventional loan, right? Or a VA loan potentially, right? What are the things that they're going to ask? Because I do those kind of loans also, right? So what are they going to ask, and what are they looking at? So that way, hey, let's get that sorted out so you can get your financing. And then, right, we know ahead of time. And if it's something that we can never resolve, or isn't going to be something that we can solve over a period of time, because basically most of these things are more seasoning, and hey, we got to work on it over a period of time, whether it's 18 months, 24 months, 36 months, to get it lined up so that way it fits into the traditional box. Then now you have a solution for it. But if you're not going to be able to complete that process, then we're not going to put you into one of our properties, right? We're not, because we're setting you up to fail, and then we don't want that. I think that's just bad business, right? Yeah. I'd rather have people complete the process and everybody walks away happy, getting what they want, rather than have issues down the road, right? And sometimes we got to tell people no. It's like, no, no, you can't afford this house. This is 750, and you're only make income for 400,000. So why are we going to put you into that, right? You're going to be, one little hiccup here, and you're not going to be able to pay. So that's just not good for anybody, right? Sometimes we got to tell people no.
Yep. So that basically covers number 3 in our list, is working with a lender to figure out what that plan is. And if people didn't catch, you are a lender, so you know all those programs. I'm not a lender. I do work with a lot of different lenders. I'm a licensed agent, so part of our process is getting with a lender that can kind of help us do that screening and figure out what that game plan is.
Yeah, so let's kind of talk a little bit about that process, because it kind of layers into that, right? It's important to know what the individual situation is from a lending perspective, so that way the exit can come in with traditional financing. And to do that, you have to go through a screening process just like a traditional loan, right? Now, majority of the time, we'll know because you told us, hey, my lender said no because of this. Okay, great. We understand that. We can be flexible on that aspect of it while that gets cleaned up, so that way that's not a problem in 18 months or a year or 2 or 3, however long it may take, right? Some we have some people that'll turn around in 18 months, even sooner, as fast as 15 months, right? And then some of them we could go as long as 4 years on a bankruptcy, or maybe even 5 years if it's something else that's keeping it. They're waiting for I don't know, permanent immigration situation or something along those lines, right? So we can be flexible, unlike the banks, but there has to be an exit strategy. There has to be an exit in place, so in a game plan, so that way we know that, hey, you're going to get your financing and you're going to move on, get your own financing, and then you're just going to make your payments directly to the traditional lenders and so forth, right? And everybody goes on their merry way, and everybody got what they wanted, right? So getting pre-screened is important, right? Yeah. So if you've never been pre-screened by a lender, we can do that for you, right? And give you an idea of what your situation is, right? And sometimes people think, hey, you know what? I think I don't qualify, but sometimes they do for traditional financing. So I tell people, look, if you haven't applied for traditional mortgage financing in the last 6 months, let's go through this process again, right? If you were pre-qualified 2 months ago, then usually that information is going to be pretty valid, right? But anything over 6 months, your situation could have changed. And a lot of times people think, oh, I don't qualify. I ask them, it's like, well, have you tried to get pre-qualified? Oh, no, I haven't. I just think I don't. Like, well, you don't know, right? Like, yeah, typically most clients aren't the experts in this field, right? They don't know what the qualification requirements are like the back of their hand, like we do, right? So we go through that process and say, hey, let's fill out the application. Let's get your information. What does your income look like? How long you been at your job? What's your pay stub, bank statements, and those other stuff, and see what you could qualify for. And then that way you can have the surety to go shopping at the right price, right? It doesn't help you to go look at houses in $1 million when you only qualify for 500,000, right? No agent is going to make an offer you haven't been pre-qualified for $1 million. It just doesn't make any sense. A lot of people would be wasting your time, and you as the client would be wasting your time too. So we don't want to do that. Right? We want to know exactly, hey, you qualify for this. Go with the agent that either referred you to us, or James, or one of our local agents that we work with or the agents that we work in the different markets. They're going to help you find the house. And once that house has been identified, we're going to have a conversation to make sure, hey, are you sure this is the house you want? Yes. Are you positive? Yes, because you're picking it, right? We don't have an inventory of 2-3 houses that you may or may not like. We are allowing you to pick it. So that way down the road, you say, well, I didn't want this crummy house that you gave me. It's like, well, you picked it, right? So it's not us that are picking it. So you get the opportunity to pick it as the buyer. And working along with the agent, and then we can go from there. And then at that point in time, then we sort of take over in the transaction to make an offer on that property and kind of get you set up on the program. So that's kind of the way that we approach, 2 and 3, basically, screening the clients properly, setting them up to succeed, and then working with lenders. And I mean traditional or licensed lenders, because there are some lenders out there that are private lenders. That's not a bad thing, right? But private lenders can't get you an FHA loan, can't get you a conventional loan, can't get you a VA loan, right? Those loans have to be done and originated by licensed lenders, right? And then there's regulations for that. You have to be licensed, you have to take tests, and every year and so forth, right? So there's regulatory requirements for that as lenders and banks and mortgage brokers. So, but if I know there's some lenders that was like, oh yeah, we lend. Yeah, on the commercial side, it's not as much, right? If you're going to do business purpose loans, I get a lot of hard money lenders, or hey, for rental properties, that's a different criteria. But if you're going to be owner occupant, you need to work with a licensed lender. Anyway, so that's bullet point 3. Anything you want to add to that?
Nope.
All right. What about number 4? What do you think of number 4?
Working with credit repair companies. Yeah, sometimes people do need help with credit. Not all the time. Like ideally self-employed, writing too much off on their taxes, not claiming enough. They don't have any credit issues. They just need some time to qualify. But a lot of people do have credit issues. So working with a credit repair company, if needed, is something we'll do. We'll recommend ones that we like and trust, because credit repair companies aren't created equal. So, and I also say that a lot of lenders can give advice on what to do to fix credit, but sometimes you need a little extra hand holding with a credit repair company. So,
yeah, so it's going to depend on how involved or to what extent your credit situation is. Some things you won't need a credit repair company. Some of it is, hey, this you filed the bankruptcy last month. Okay, nothing a credit repair company can do. They're not going to be able to take that off, right? Credit repair companies can't take off something that is factual and true, right? If it's not factual and true, either a credit repair company can dispute that for you, or you can go dispute that on your own, right? The lag time for that may vary, right? But if it's something that is factual, no credit repair company can take that off, right? So a bankruptcy or a foreclosure or a repo or a short sale or a deed in lieu of, those things are a judgment, right? If they're recorded with the county, they're public records or something along those lines, that's no credit repair company is going to be able to take that off. What they're going to help you though is clean up the stuff that may not be yours and go about the process of disputing that, right? And so there's a process. So if you're part of our program, we can refer you depending on what it is. And some of it is like, you filed bankruptcy last month. It's not a whole lot that you can do to clean up. You just need time, right? So the question is whether it's going to be 2 years, 3 years, 4 years. How long is it going to be? And then based off of that, our agreement is going to be based on your particular situation. So some people are set up after 2 years. Some people are 3, 4, 5. So your unique situation is how we customize our rental program to give you enough time to have that either fall off because of time or have a lesser impact on your credit score. Because when it comes to credit, the more recent it is, the higher the impact it has. The older it gets, the lesser the impact it has. And then traditional lenders have a seasoning period where, hey, if you had a late payment on your rent or your existing mortgage in the last 12 months, you can't get FHA financing. It has to be at least 12 months. So there are certain timelines that they'll say, hey, if it's within this period, you don't qualify. Now, once it's over that period, then they'll exclude that and they won't look at that factor any longer, right? So knowing those timelines is important. And so that's why we as lenders, or me as a lender, or working with a lender, should be able to tell you that and give you a timeline of how long that's going to take, right? But that's why we go through this pre-screening process. So yes, you may need a credit repair company, or you may not.
Yeah.
Typically, and so that leads to another segue I kind of want to touch upon, right? Is most people think that rent to own is only for people that have bad credit,
right?
And that's just not true, right? The majority of our clients have good credit, even great credit, right? And so that's not the only thing that keeps them, or it's not the thing that's keeping them, right? So can you kind of touch upon the other scenarios that keeps people from qualifying for a traditional loan besides credit? So somebody comes to you and say, hey, my credit is perfect, but this is the other thing that's keeping me from getting qualified. So what are some of the things you've encountered?
Yeah, the main one is it's self-employed. Newly self-employed, they need a full 2 years typically, showing that track record. So banks don't want to lend to somebody that's doesn't have a good track record and doesn't have a W-2 job. So that's kind of the main thing. Go ahead.
Yeah, no, I mean, so definitely self-employed people, newer self-employed people that haven't filed their taxes because they're delayed and they kind of want to avoid all of that, right? You should, if you're self-employed, you should file your taxes because you're going to accrue penalties and interest. But let's set that aside for a moment. So self-employed people, people that are getting relocated, right? People move. Right? It's like, hey, I used to be, I don't know, an engineer, and now I'm going to be. I had somebody. It's like, hey, I left my engineer job, and now I'm going to be a real estate agent. Like, okay, right? The way you get paid is different. You get W-2 and pay stuff as an engineer, but if you're a real estate agent, now you're 1099, self-employed. You don't have a history, right? So you're changing industries. If you're relocating, if you're moving a business, hey, I don't know, I have a carpet cleaning business in LA, but now I'm moving to Denver and it's a new carpet cleaning business in that market. Well, you don't have the same contracts. Say you were working with commercial carpet, commercial offices, and you had a contract to show, hey, I have agreements that I'm going to be their contractor to clean the carpets for a year or whatever, right? So you're in a new market. You have to reestablish yourself. How about being an agent in LA and you move to become an real estate agent in Dallas? Well, your relationships are different, right? You don't have the same clientele because they're not moving with you, right? Whatever you build over 5-10 years as an agent in one particular market doesn't carry forward with you in another. Now you have skills to kind of start that process up and generate that business and make yourself known in that market, or but what you were able to do in that other market is going to be different than what you do initially, right? At least for the first couple of years, it's going to take you some time to kind of ramp up and get yourself back to where you were. So lenders will look at that. It's like, okay, is this consistent? Is this predictable? Can we rely on this? Right? That's what the lenders look at, especially underwriters are looking at, hey, what are the factors that add additional risk for us to give them loan? Just because you were making, I don't know, $500,000 in LA as an agent, and now you're moving and you're trying to buy a house in Dallas, doesn't mean your first year you're going to make $500,000 or second year, right? It's going to take you some ramp up time. So factors like that are varying. That's like, oh, well, I guess I didn't know that. All right. So lenders look at those kind of factors that are different. I know you're the divorce person, right? You're you kind of niched out on some of the divorce stuff too, like people go through the divorce. You want to talk about that? And you want to
happens all the time. And I really rely on my lenders that know that whole process too, to kind of figure out that game plan, because that can get sticky, and figuring out what can each party afford, what are we doing with that original house, timing of that. So we can look at that for sure. Yeah,
so having an understanding of that, right? So we can kind of walk through, what's your scenario, what's your process, who's keeping the houses, or is somebody keeping the house, or is it going to be sold and the equity is going to be split? Does it have to go through the court, or are you guys doing this amicably? Is there a separation agreement? So some people say, yeah, I'm getting divorced. Like, okay, you have the copy of the divorce decree? No, we're in the process of getting it. Okay, so you're really not divorced until the judge stamps the divorce decree, right? Yes, getting a divorce doesn't mean you are divorced, right? And sometimes people are like, oh, we got a legal separation agreement. So that adds a factor. Legal separation is going to say, hey, who's responsible for what debts? Who's going to get what? Who's going to get this money? Who's going to get that money? Same thing with the divorce decree, right? If you already agreed upon and it's finalized, then we can kind of make decisions off of that, or at least give you a path and say, look, you got to go through this process and decide that either on your own or through a third party intermediary, or through the judge and attorneys, right? Depending on how you're going to dispute this, that, or the other, who gets what. So, but there's a process, but there's also a solution for it. It's just understanding where you're at with that, and then what's been agreed upon and what hasn't been agreed upon. So, and that may mean, in that situation, maybe, hey, our credits are fine. We're just trying to disperse our funds and what we're going to do. Or in those instances, sometimes what happens is people, kind of their credit is impacted because they're fighting or arguing about who's responsible for what debt and so forth, right? They're in that aspect of, hey, no, it's yours. No, it's yours. And, you got it. No, you got it, and whatever, right? So they end up kind of impacting their credit. They're not making the payment, and then it kind of affects their ability to qualify for financing because they just went through that process, right? So that's helpful. So we can specialize in that in your situation. You have your book you want to show?
I don't have it in front of me.
All right.
But yeah, if anybody has questions about working through divorce, contact me or Dom.
Yep. Yeah, James has a book for it, and obviously, from a lender's perspective, we kind of bounce off. Okay, what's the situation? Here's the best approach to do it. So yeah, we work in tandem on that if you have a situation like that. So yeah, so I wanted to emphasize, when it comes to credit repair, rent to own is not just credit issues. It could be a factor, but majority of ours isn't credit. We've had, we have other stuff. We have somebody that's going through, getting their immigration status updated, or they're working on the visa extension because their employer is the sponsor and they're from overseas, right? And they need sponsorship, and that sponsorship is either expired or they're getting it renewed or something to that effect, or they got an offer from an employer and that's sponsoring, but they may not be U.S. citizens or permanent resident aliens, but they have a visa and they have a temporary visa or temporary residency, right? So different situations like that, right? We get clients that are ITIN buyers, right? So they're not U.S. nationals or citizens yet, right? But they have an ITIN because even people that are not U.S. citizens have to file tax returns if they make income in the U.S. And so they do it through an ITIN, just like a social security number, or just like an EIN for businesses, right? So they still have to file their tax return, right? So potentially maybe they need to file tax returns, or they haven't filed, or they didn't know, or they have. But if you're an ITIN, you can't qualify for an FHA loan or a conventional loan or a VA loan.
No.
ITIN clients can't qualify for those kind of loans. So there are other programs, and then our rental program helps them with that, so that way they can, however long it's going to take to get that cleaned up and dialed in, so that they can get financing down the road, right? So there are multiple factors other than just credit.
Yep.
All right, you want to talk about number 5?
Yeah, we've basically covered that. So we're giving people time and tools to get qualified. So like the self-employed people, a lot of times they just need time. And if there's credit repair involved, that's a tool. So those are some good examples of time and tools.
Yes. So time and tools, right? And understanding that, and this sort of leads to, I guess I'll segue it to, right? You have a scenario of a client, right, where they were doing a version of rent to own with a private individual, and that private individual clearly does not understand the timeline that it would take them, the buyer, to get traditional financing, right? Because they did that agreement is way too short. They did a 6-month agreement,
Yeah.
and now that person is saying, "Hey, where's my money?" And then that person in the 6 months couldn't get financing. So now you may potentially have a dispute as to, well, I told you 6 months. Like, yeah, but it took me longer, whatever that may be, right? So having an understanding of what that exit is going to take, and obviously this person is not a lender or probably didn't work with a lender to tell them, hey, you know what? They could get financing, but it's probably going to take them a year or 15 months or 18 months, right? So 6 months is way too short.
Yeah.
It's never enough time. I mean, I haven't seen it, right? I haven't seen it. Now, if somebody hits the Powerball and they got the money within 6 months, okay, fine, great. But generally, the majority of people lead at least, 12 months, 15 months. I've seen 15 months as soon as it's 15 months, but 12 months generally covers some things, like late payment. If I had a late payment on my rent or my mortgage, you need at least 12 months of untimely payments to qualify for FHA loan.
Yep. And that's
Right.
the case with this couple. They did have a late on a couple different lates. Oops. Well,
yeah,
now they can't qualify.
Especially mortgage and rent. They're sticklers with that, right? And obviously, right, if we think about it logically, if people have a hard time making a payment on time with their rent and their existing mortgage, then a new loan or a new lender is going to say, well, you can't pay this one. And what makes us think that you're going to be able to pay this one, the new one, right? So they want to see on-timely payments for at least the last 12 months to be able to get financing for a new mortgage. That's the most basic thing that you can do, right? And then now, as it relates to other credit items, that could vary. Car payments, credit cards, student loans, another one. Student loans is the big thing these days, right? There's a lot of stuff in the news talking about student loans, student loan forgiveness and whatnot, right? There's a lot of people that have a lot of student loans. As a matter of fact, I'll talk about another example, but student loans, right? So when those are subsidized or backed by the government, and you're not paying those on time and you're late or you're in default, the government is going to give you new financing on FHA or VA,
Heck
right?
No.
Heck no. Like, if you can't pay this one that's subsidized by the government, what makes us think that we're going to be able to give you this other one, right? So that is definitely a no-no. Student loans that are subsidized by the government, either through interest or whatnot, that throws up a big red flag when it comes to FHA and VA. You won't be able to get financing if you defaulted on government debt. So if you got let's see, you got an SBA loan, or during COVID, right? We had PPP,
Right.
right? We had a lot of those. Businesses borrowed money, got money from the government, even though the interest rate is cheap, because the interest rate was being subsidized by government. You're set up with the SBA to make those payments on those loans that came out through COVID. If you're late on those or you're in default on those, you're not getting an FHA loan, not getting a VA loan. They're just going to flag.
Yeah.
It's like, this person is not eligible. People don't even know it.
Yeah.
They don't even know that, right? Another scenario that I want to talk about is as it relates to student loans. We know people over I'm going to say probably the last 25 years, the cost of higher education has gone up big time, right? People have taken on a lot of debt and student loans to pay for college, right? Well, eventually you have to start paying that. So that debt has to be accounted for in your total payments when you go get financing for a mortgage, right? And in this example, somebody brought a potential client for us that they're a doctor and they have almost $200,000 in student loan debt. That's a big payment. They don't qualify because that payment is almost like $1,800 a month, right? How many people, even a doctor that could make $200,000 a year or $250,000 a year, you tack on an $1,800 student loan payment plus the mortgage plus potentially the car plus any other consumer debt, they don't qualify.
Yeah.
Right. So that's a factor. Student debt is keeping for people from qualifying. Now, you should be looking for other solutions potentially, right? Hey, Kate, can you get a gift from family member to either help you pay that down or pay it off, or help you pay off some of the other debt? Maybe they won't be able to pay off the $200,000 student loan, but that's okay. Let's pay off the car. Let's pay off the credit card. Let's pay off this other thing that's less. And then, okay, we take that out, and then now you just have your mortgage and your student loan for your medical education or pharmaceutical or dental or whatever that may be, right? So other potential solutions to kind of work through this process. But yes, student loan debt it's a big factor these days in people not being able to get financing, and that has nothing to do with credit, right? So,
right. Yeah.
All right, and then this one here, the bonus. We're going to give everybody a bonus, right? And obviously, this is a change of the times. And when I talk about the change of the time, is because where the market is and the way that the big players basically have left most markets and not even buying, right? So there are a couple of big players that were doing this. We're doing a rent-to-own method in certain markets, not everywhere, but in certain markets. And they have pulled out of the market. They're not even buying. And in the couple of markets that they're still buying in, they're basically making offers at 10 to 15% below listing price.
Even more, like here in Denver.
Okay.
I've heard 30% below
30%, right? Well, yeah, you're never going to get an offer accepted that way. That's crazy.
Yeah, so sellers,
so why are they even bothering?
Sellers aren't that desperate. It's softened, sure, but yeah.
Yeah.
So they're just wasting everybody's time.
Yep. Yeah, so they're not even buying. They're not making lowball offers and hoping and praying, right? They want to say, yeah, we're still in business, wink, wink, but we're really not trying to buy anything, right? Just because we don't want to shut down and say, oh, we're out of business now, right? They're just saying, yeah, we're still in business, but it has to be, it has to be like a unicorn for them to do it, right?
Yeah. Yeah.
So I want to talk about the way that we approach that, right? So our offers are going to be based on listing price or appraised value, right? So it has to appraise. So if somebody's listing a house that's really $500,000 for $1 million, that's never going to work, obviously, right? It has to be a realistic listing price, right? What's the market say, right? Now, we're not lowballing people. We can make an offer based on listing price. However, it still has to appraise, right? Because we're taking a lender's approach to the transaction. Like, it has to appraise. And if it appraises, great. Then it's the listing price. If it doesn't appraise, then we're going to have a conversation. Just like if I was a buyer getting an FHA loan and the appraisal didn't appraise, well, no lender's going to give me a loan on $500,000 when it only appraises $400,000, right? That's just not. So there has to be a conversation with the listing agent. It's just like a traditional sale, right? It's a negotiation back and forth, and if the seller wants to move forward, then they can. If not, then they can also say no. So it has to appraise, right? And that sort of leaves us in the sense that, hey, it isn't us saying it's worth less. We have an independent third party that's licensed to do that is accepted by lenders to be able to make that decision, right? Yeah. The other thing we don't do on the opposite end is, hey, if the house is listed for $500,000 and you got 10 bidders and people are offering $50K, $100K over asking price, that's definitely not going to be a fit for us, right? Unless potentially the tenant buyer has that money, right? Has the difference in money to be able to do that. Okay, sure. If you want to put up that money for that difference, by all means, right? But generally, most people aren't doing that, right? That's typically, hey, I have a cash buyer and I'm moving from, I don't know, sold my $1 million 2-bedroom 1-bath in California, and I have, I came out with $600K equity, and then I'm just gonna overbid in a house, I don't know, in Vegas, Denver, Phoenix, Wyoming, wherever they went, right? So So they obviously don't need us for that, right? They're going to pay cash. But yeah, so we don't do bidding wars. It has to appraise, and then anything over that, if somebody wants to overbid, then they would have to have that difference in funds themselves, and that's okay.
Yeah.
So, and then the other thing is, you want to talk about builders, new construction, new builds.
Yeah, we can do new builds for sure. I mean,
Yeah, so new construction is one. Yep, go ahead.
No, go ahead.
Yeah, new construction is right. So now, when we say new construction, the builder, there's a couple of qualifiers involved with that. One, the builder has to be okay with an investor buying a property, because we have some builders that say, "Oh, we don't sell to investors," right? So that's a qualifier, right? So if the builder is okay with investors, okay, potentially. Two, it has to be a spec home or a property that can close and be completed within 30 to 45 days from when we make an offer. Right? It has to close. It can't be, hey, we just picked out the lot and they haven't even put the foundation yet, and it's going to be completed in 9 months. That's not something that we're going to do, right? Because we don't know what's going to happen in 9 months, right? You potentially the person that wanted that house in 9 months, something could happen. That's just too long of a timeline. They could potentially lose their job. They could potentially get divorced. They could potentially just change their mind, right? And so we're not going to be stuck with a property that we don't want, right? Because obviously we're not going to live in it. So we don't buy a house that we're not intending to own, right? We basically have you pick it out. You're going to live in it. You're going to want it, right? We're not intending on owning that property as an occupant, right? So that's a different conversation for us. It has to make sense in the timeline, so that way the less potential pitfalls can come up, and people changing their mind or whatever, right? And then the other thing with builders is, if you want to upgrade to the golden toilets, right? The builder is going to say, hey, we need an additional deposit for all these upgrades, right? They want that deposit up front before they make those changes and put in the work order to go ahead and make those upgrades to the house, because they're customizing it to your liking, right? Well, we're not going to put that money up. If the buyer wants to put that money at risk and they have it to put it up, and if they change their mind, the builder isn't going to give you that money back. You're going to lose that money. If you're willing to go ahead and do that, then we would consider. But typically, that's not what happens. It has to be a spec home generally. And then obviously, once you own it, you can upgrade it all you want. But generally, if you're trying to do a bunch of upgrades and you don't have the money to pay for the deposit of those upgrades, then that's not going to be a fit for us. It has to. So the majority of people is, no, I don't have the money, or no, I'm okay with the. Generally, a spec home is going to be livable. It's not going to be 50K in upgrades, but again, it's not like we're picking it, you're picking it, right? So you have to understand, hey, the spec home that this builder is building is going to include everything that I need the way I like it, and that's good enough.
Yep.
Right. And then after the fact, if you come into money and you want to put in the golden toilets, by all means. Right. So I like to qualify that on the builder side. So potentially yes, but there are some things that come into effect with that. All right. So anything you want to add? Any final thoughts there, James?
I think we covered it. Top 5. We're the best.
That's right. And we're still doing this, unlike a couple of the big players who shall not be named, even though I'd like to name them, but call them out. But no, that's okay. That's okay. Yeah. We understand why we're the best in the industry, and why we have all these guardrails around the potential pitfalls and what could happen, and why we have our process set up this way, right? The number one goal is to help people become homeowners, right? And set them up to succeed.
Yep.
All right. Well, that's all we got for today. James, if people want to get a hold of you and kind of reach out and run some scenarios by you, get a copy of your book and so forth, how can they get in touch with it?
Yep. Just go to Linktree partner with James Brown. I got a bunch of links on there.
Cool.
Yep.
All right, well, that's it for today. People want to get a hold of me. I am on Instagram, YouTube, and TikTok at Mr. Rent to Own Homes. And then our website is on www.rent2ownhomes.us.com. That's our website, and it's on the top of the live here. And then also the information will be in my bio on either Facebook, YouTube, Instagram, and we're not on Twitch yet, but maybe that will be coming soon as well, right? All right, that's it for today. Until next time, my name is Dominic Danino, aka Mr. Rent to Own Homes, and this is the Mr. Rent to Own Homes Show. See you next time. Bye-bye.